Hey! Today, I'll talk about the chart of accounts and journal entries. Don't forget to share this video with a friend that's eager to learn as much as you. Meet George. He was hired as a consultant to help the setup of an organized accounting department in a fast-growing startup named FlashStart. He's now working on the double entry system. The notion of double entry is simple but effective. Each of a company's transactions will result in an amount being recorded in at least two of the accounting system's accounts. George will need to produce a complete list of all the accounts that FlashStart would find relevant for reporting transactions before he can start setting up his accounting system. A chart of accounts is the name for this detailed list. A chart of accounts, known as COA, is a financial organizational tool that provides a complete listing of every account in the general ledger of a company, broken down into subcategories. It separates expenses, revenue, assets, liabilities, and equity, ensuring that financial statements are in compliance with reporting standards. To make it easier for readers to locate specific accounts, each chart of accounts typically contains accounts by a name, brief description, and an identification code. As a side note, when you use an accounting software, sample charts of accounts for various sorts of businesses are frequently included. The chart of accounts will assist the accountant in selecting two or more accounts involved when he records his transactions. As time progresses, he may discover that he must expand his chart of accounts, or delete account names that are no longer in use. Here's some sample accounts that will probably be included on his chart of accounts. Balance sheet accounts as asset accounts. Examples are cash, accounts receivable, supplies or equipment. Liability accounts. Examples are notes payable, accounts payable or wages payable. Stockholders' equity accounts. Examples are common stock or retained earnings. On his income statement accounts, there will be revenue accounts. Examples are service revenues and investment revenues. Expense accounts. Examples are wages expense, rent expense, and depreciation expense. In order to understand how the chart of accounts works, you need to understand what debits and credits are. The double entry system demands the transaction's dollar figure to be entered on the left side of one account and the right side of another account. Rather than the word left, accountants use the term debit, and instead of the word right, they use the term credit. Following this logic, you ask yourself, how do you know which accounts you should debit or which accounts you should credit? For that, you need to look at the following equation. Assets equals liabilities plus stockholders or owners' equity. The asset accounts in the general ledger have their balances on the left side, just as assets are on the left side, or in accounting terms, debit side of the accounting equation. You can increase your asset balance by adding amounts on the left side. On the contrary, to decrease the asset balance, you will enter amounts on the right side. Or in accounting terms, credit side. The liability and equity accounts in the general ledger have their balances on the right side, or credit side, of the accounting equation, much like liabilities and shareholders' equity. You can increase your liability or stockholders' equity account by adding amounts to the right side. On the contrary, to decrease a liability or equity, you debit the accounts, meaning enter the amount of the left side of the account. So that you can understand how this works, here's two examples of transactions that FlashStart will meet. Let's suppose the initial cash balance of FlashStart is $50,000, and its stockholder equity is also $50,000. Example number 1. FlashStart purchases a service car on the 15th of December by writing a check of $10,000. The payment is made on the form of a check, hence, they are effectively exchanging cash by a vehicle to be used for service. On accounting terms, FlashStart is crediting the cash account versus debiting the vehicle's account. The balance sheet impact as follows. Cash decrease from $50,000 to $40,000, due to the $10,000 spent on the purchase of the vehicle. Vehicles increase in $10,000, as we recognize the purchase. Stockholders' equity remains at $50,000, as it was not affected by this transaction. Example number 2. On the 16th of December, a customer buys from FlashStart with a check of $30 in exchange that a technician from the company go to the customer house to fix his internet connection. Because of the double entry system, we know that there must be a minimum of 2 accounts involved. One must be debited and the other must be credited. As FlashStart received a $30 check, it will debit the cash accounts on the balance sheet, as it earned the $30 due to providing a service, and it will credit the service revenue account in the income statement. As mentioned in previous videos, we record revenues when they are earned, not when cash is received, which in turn results from a basic accounting principle known as the revenue recognition principle. The journal will look like as follows. Assuming that the financial year end at the 31st of December 2022, the balance sheet and income statement impact are as follows. Note that the retained earnings account receives the profit and loss balance at year end. In our case, there's a net gain of $30. Now, here's a summary, with the main points to help you as a guidance. In the case of when a company is paying cash in exchange of something, the company will credit cash, and will have to debit a second account. On a company with yearly financial statements, if the amount is used up or will expire in the current year, the account to be debited will be an expense account. Examples are rent expense or salary expense. If the amount is not used up or does not expire in the current year, the account to be debited will be an asset account. Examples are prepaid accounts or supplies. If the amount reduces a company's obligations, the account to be debited will be a liability account. Examples include accounts payable, notes payable, wages payable, and interest payable. On the other hand, when a company receives cash, the company will debit cash, and will have to credit a second account. If the amount received is from a cash sale, or for a service that has just been performed, but has not yet been recorded, the account to be credited is a revenue account, such as service revenues. If the amount received is an advance payment for a service that has not yet been performed or earned, the account to be credited is unearned revenue, or sometimes called as deferred revenue too. If the amount received is a payment from a customer for a sale or service delivered earlier, and has already been recorded as revenue, the account to be credited is accounts receivable. If the amount received is the proceeds from the company signing a promissory note, the account to be credited is notes payable. If the amount received is an investment of additional money by the owner of the corporation, a stockholder's equity account such as common stock is credited. Revenues are recorded as service revenues or sales when the service or sale has been performed, not when the cash is received. This reflects the basic accounting principle known as the revenue recognition principle. If you have enjoyed, want to keep on learning and still did not subscribe to the channel, you can do it today, by clicking on the subscribe button below. Thanks for watching and, I will see you again soon.